Booking Holdings has risen more than 200% in the past 5 years and might be one of the most underappreciated stocks in the market right now. I built a 10-year discounted cash flow model, and based on my assumptions, the fair value comes out to roughly $10,400 per share, compared to a current share price closer to $6,000. That implies a potential annual return of 16%, which is why I'm giving Booking a buy rating and 4 out of 5 stars. But why is one of the world's most powerful online travel platforms trading at such a steep discount? Well, in this video I'll break it down into 4 parts, starting with what actually drives Booking's business, followed by a look at the financials, a bull versus bear case valuation, and finally a technical analysis showing when might be the best time to enter the stock. So yeah, let's jump in. And before we dive into Booking's business model, let's take a look at where the company is today. We can see that revenue has grown by 11% in the past year, and EBITDA has grown by over 32%, which is absolutely massive. This has resulted in an EBITDA margin of 39%, which is roughly double where it was just 5 years ago. Now the share price has also risen right by over 50%, and the company is headquartered in Connecticut in the United States. So Booking Holdings is the world's largest online travel agency, behind major brands like Booking.com, Priceline, Agoda, and Kayak. The business model is built on scale and simplicity. Connect travelers to hotels, flights, and rentals, and take a commission on every transaction, usually between 15 to 20%. It's a capital light, high margin, and globally scalable platform. With over 1 billion room nights booked annually, Booking benefits from a powerful network effect. More users mean more reviews and listings, which drive even more bookings. They also run one of the most sophisticated performance marketing engines in the world, efficiently turning ad dollars into revenue. Now, Booking is expanding into payments and travel fintech, aiming to boost customer retention and capture a larger share of each trip's value. And this is a cash generating machine at the heart of global travel, and in my view, it's trading well below what it's really worth. Now, with all of that said, the bull case is quite clear. First of all, we have travel tailwinds. Global travel is back, and Booking is perfectly positioned to benefit from long-term demand. On top of that, we have unmatched scale. Booking leads in global hotel supply and is expanding fast in flights, experiences, and fintech. And lastly, we have high free cash flow. The company's asset-light model and strong pricing power means margins stay high. However, we also have a bear case as well. First of all, consumer spending risk. If macro conditions worsen, then travel could be among the first expenses consumers cut. We also have competitive threats. Google is pushing harder into travel search, and Airbnb's unique inventory appeals to younger travelers. And lastly, we have geopolitical risk. With most of Booking's revenue coming from outside of the US, geopolitical instability could impact earnings in the future. Okay, so now we have a sense of what Booking actually does as a company. Let's move on to the financial analysis and see how has the company performed in the past 5 years. And to do that, we'll start off by looking at the core financial performance over the past year for the company. Here we can see the revenue in blue, and to compare we have the EBITDA in green. And yeah, we can see the revenue has grown from 7 billion all the way up to close to 24 billion, which is 37% per year, which is really impressive. At the same time, the EBITDA has grown by 56%. So not only has the company grown its revenue, it's also become much more profitable at the same time. This is reflected in the EBITDA margin. As you can see, it was 23% in 2020, and in 2024 it was close to 40%, which is really great news for new investors. I also like to take a look at the debt sustainability of each company to see if that is any risk for us as new or existing investors in the company. And here we can see the debt in the company as purple and the excess cash in green. And yeah, we can see that debt has indeed grown by 8% per year, but at the same time, the excess cash has grown by 11%, so at a higher rate. And we can see pretty much the excess cash can cover the entire debt within the company. And as we later on will take a look at the free cash flow as part of the valuation, let's also take a look at the free cash flow performance of Booking. And here we can see again the revenue in blue, and instead of the EBITDA, we have the free cash flow to equity in green, right? So we can see, yes, revenue has grown by 37%, and as we saw with the EBITDA, right, the free cash flow has grown at a higher rate, showing that the company is becoming much more profitable, which is a great sign. Another interesting chart which is showing some positive signs for investors has to do with the share performance of the company. And first of all, we can see the share price, right, as the dotted line that has of course risen quite sharply in recent years, but we can also see the number of shares outstanding in the company as these blue columns. these are in millions. So these were 41 million in 2020 and it has dropped to 33 million in 2024, showing that the company is aggressively buying back stock. That's a good sign, and this has helped the share performance to grow by 22% per year, which is a great return for investors. Okay, so now we have taken a look at the strong financial performance of Booking in the past 5 years. Let's move on to the exciting part, which of course is the valuation part. And to kick off, we'll take a look at the assumptions behind my model, and these assumptions go all the way up to 2034, so 10 years including 2025. And let's start off with revenue growth. I'm assuming a conservative yearly growth rate of 9%. Now in the past 5 years, it's been 37%. Now that's of course starting off with a much lower base. The company has grown quite a lot in the past 5 years, and the company has guided roughly 11% revenue growth for 2025. So 9% on average for the next 10 years, I think it's quite realistic for Booking. Now in terms of EBITDA margin, I'm assuming 42%. In the past 5 years on average it's been 29%, but we've seen the company is quite close to 40% today, so 42% isn't that unrealistic in my opinion. Now in terms of enterprise value to EBITDA multiple, I'm assuming 15 times. In the past 5 years it's been 31 times on average per year, but of course as the company becomes bigger, growth will slow down, right, and the multiple will compress. So I think that's a realistic assumption. Now with that said, let's move on to the free cash flow assumptions as well. I'm assuming 10% yearly growth rate for the free cash flow. That's higher than the revenue growth, assuming that the company will continue to expand its profitability in the coming 10 years. Now for the free cash flow yield, I'm assuming 5% per year. That's higher than the 3.2% in the past 5 years. And finally, the discount rate I'm assuming for my discounted cash flow analysis is 11.1%, which I think is quite reasonable for a company like Booking Holdings. And yeah, with all of those assumptions in mind, here you can see the revenue and the free cash flow that I'm forecasting for Booking in the coming 10 years, all the way up to 2034. As you can see, the growth rate for free cash flow will be slightly higher than the growth rate for revenue, all the way up to 2032, assuming that the company can expand its profitability for a few more years, which of course will benefit us as investors. Now, using these methods of valuation, we can also extrapolate a weighted price target in 2034 using the enterprise value price target that they have at roughly $14,474 and the free cash flow price target I have at roughly 12,486. And of course, if we weigh them equally, we get a weighted price target at roughly $13,500 per share in 2034. And as I mentioned in the introduction, if we discount all of those future free cash flow assumptions to a present value of today, we get a fair share price of $10,400 per share, showing us that the company is trading at a 45% discount if we compare our fair share price with the current share price of Booking. This also implies a 16% annual compounded return that we as investors could get from the stock. And this is quite interesting because taking a look at the stock chart, you can see that the stock has risen by over 50% in the past year. And you could make the conclusion that yes, the stock might be overvalued today. But on a valuation basis, at least in my opinion, I think the stock might actually be undervalued, assuming that global travel can continue to expand in the coming 10 years, resulting in higher revenue and higher profitability for Booking as well. And here you can basically see how this investment could pan out. Of course, we have to invest in the stock today. We get some free cash flow in 2025 as well, but that's of course a negative year for us as investors as we buy the stock, but then we get some free cash flow distributed to us each year, right? That could be by buybacks, that could be dividends or what have you. And then eventually we have to sell the stock at our price target plus any free cash flow in 2034. Now, looking at individual stocks like Booking, I think it's important not only to be optimistic, but also take a look at the pessimistic scenario, right? What happens to our potential investment returns if the revenue and the free cash flow does not grow in line with our expectations? And to do that, I basically added the bear case analysis as well. In this case, I'm assuming revenue growth and free cash flow growth to only be 5% each, right? If we assume those new growth rates, we get a fair share price of roughly $6,872 per share. And this is quite interesting because this is still a discount if we compare it with the current share price of Booking today. This also drags down the annual return from 16% in our bull case down to just 6% in our bear case. But 6% is still quite okay, right? We're not losing money despite the company not performing in line with investors' expectations. But then the question becomes, if you are interested in investing in Booking and believe that the company indeed is undervalued today, when should you enter the stock, at least on a technical point of view? Well, here we can see the stock chart of Booking over the past few years, and what we can see here is that the stock price has indeed gone into a long-term upward sloping trend channel. The stock price is rising and investors are giving credit to Booking and the revenue growth that they are performing. Now, if we zoom in a bit, we can also see that the stock price is above this kind of blue line here, as you can see right on the screen. That's the 200-day moving average. That's another good sign, right? We want to buy stocks that are above the 200-day moving average. However, we can see that the stock price is at the upward limit of this trend channel, right? Usually when stocks are within these channels, we like to buy them when they are bouncing from the lower part, right? For instance, we can see here back in April of this year, or back in August of last year. And I think that will come again for Booking, right? I think the stock price might go down slightly, right? And bounce again within this upward sloping trend line. And that could be a great buying opportunity. Now, if the stock price actually goes down, here we can see what happens to our expected annual return if the stock actually goes down or if the stock continues to rise. So let's say that the stock actually goes down by 20%, then our expected annual return grows from 16% per year all the way up to 20%. However, if the stock continues to rise, let's say by 20%, then the expected annual return drops all the way down to 13%. And to conclude, before I move on to my final rating, I think this is what makes Booking a great stock. We have, first of all, a great business, and we have a company that is, at least in my opinion, well priced. On top of that, as we saw with the technical analysis, this stock does have momentum. It's going up to the right, and investors are giving credit to the amazing performance of Booking's management team. Okay, so let's move on to the final part and see why the company has scored so well in my final rating. And as I mentioned in the intro, I gave the company a buy recommendation. Of course, that's not financial advice. And then I gave the company 4 out of 5 stars. And yeah, here you can see all the key criteria behind my final rating. You can see that the stock has performed or scored quite well across pretty much all categories. But there are a few things I think you should know about as an investor potentially going into the stock. First of all, when it comes to consistent stock performance, I wouldn't say that's a yes, right? Well, the stock has performed quite well in the recent 1 or 2 years, but prior to that, it wasn't really a consistent stock. And this ties into the final part, right? The company does not have low legal and macro risks. This is a company that's dependent on global travel demand, and that's pretty much discretionary spending. And that's a risk we as investors need to think about when potentially entering the stock in the coming years or today. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. And if you go down to the link in the description below, you get a free one-pager which includes 5 years of financial data, my full DCF assumptions, and the forecast summary as well. So yeah, thank you, and I'll see you in the next one.